Hello everyone, I hope you're doing well, hope you're doing alright. So this is a gold trade that I'm taking right now through to the upside, a $5,472 trade from right this area. So we're going to see how this goes. I don't have the time to explain this trade right now, so I'll explain it once it ends and I have the time to do so. So I just wanted to show you the trade right now and then we'll get into the explanation later. Let's see how this goes. As you guys can see here, the market pushed through to the upside from this area all the way up into here and continued pushing up into this $2,732 area. Now, let's analyze how I took this trade. Why did I take it? What was my bias at that point and all that? Let's go back in time to this area right here. And let's go to the 6 hours and analyze the bias first. So as I go into this area right here, I think one of the easiest ways in order to do your bias, if you're starting out right now and you want to know just a simple methodology to determine it, is look at the price right now. Where's the chart right now? The chart is right here, right? I'm going to choose one point that is above price action and one point that is below price action. So this is the point that is above price action and this is the point that is below price action. I chose this point right here because it is the point that initiated this bullish push that we're in right now. So I chose its source, which is this point right here. And at the end of the day, the market is right here and therefore we had a bearish push from here into here, a retracement, a small retracement, and therefore I chose the initiation of that retracement to the downside, and that's why I chose this point right here. Now, after choosing both these points, I can look at them and ask myself one question. How was every point created? That's it. By asking myself this question, I can then analyze the price action and determine if I'm bullish or bearish. Let me give you a small example. How was this point created right here? By the market pushing down from all the way up here to here, right? I'm just describing what I'm seeing. Why did the market push down from up here into here? To grab the stop losses, look at this. To grab the stop losses of this area. We had double bottoms right here, 1, 2, and 3, triple bottoms actually, stop losses below them, below this point right here. The market grabbed these stop losses and then initiated a bullish push. And therefore this point right here was created as a liquidity grab point. So the market grabbed liquidity through to the downside, created this point, and then pushed through to the upside. Now, how did we create this point right here? Fair and simple, if I look at the charts, what do I see here? I can just highlight this zone. We have 1, 2, 3. So this point right here serves as a third touch of this triple top right there, and then the market is retracing from it. And therefore, this point right here is a liquidity creation point, which means that this point creates further stop losses through to the upside, because right now we have this area, triple top, we have stop losses above this area right here. So this point serves a purpose of liquidity creation, and this point serves a purpose of a liquidity grab. Every point on the chart can have either one of those two purposes. It's either a liquidity grab point or a liquidity creation point. And therefore that's how you can easily determine the bias. Your chart will move in the opposite direction of your liquidity grab point. So right here, the liquidity grab point is to the downside, below the price, and therefore it will move in the opposite direction of your liquidity grab point, and it will move in the direction of your liquidity creation point. So right here, both these points are telling me that the market is bullish. Now, of course, there is scenarios, for example, where let's say this up here can be a liquidity grab point. Okay, let's say this grabbed huge stop losses to the upside and didn't actually create this triple top right here, then this would be a liquidity grab point. Since the market will move in the opposite direction of a liquidity grab point, then this is telling me that the market is going to move to the downside, and this is telling me that the market is going to continue going through to the upside. I have mixed signals, I have opposing signals, and therefore my bias would be neutral for this instrument, and I wouldn't trade it. Simply, I would move on to another instrument and look at another bias. So liquidity grab and liquidity creation, this scenario, the liquidity creation point is telling me I'm moving up because there's liquidity to the upside right here. And this liquidity grab point is telling me I just grabbed liquidity to the downside and therefore I'm moving up. Good. Both these points are aligned on one bias, and therefore I believe this is going to be bullish up until this point, these stop losses through to the upside. This is one of the easiest ways to determine bias. And of course, this then will be optimized for you. Let me give you a small example. Let's say the market is pushing from down here. It created, let's say, bottoms and then pushed through to the upside. Now, let's say this is a liquidity creation point. And let's say that this right here is a liquidity grab point. And the chart is right now, let's say it retraced a little bit. So it's right here. And therefore you chose this point and this point. This is a liquidity creation point. This is a liquidity grab point. Now in that case, your liquidity grab point is telling you I'm moving in the opposite direction. Your liquidity creation point is telling you I'm also going to the downside. Good, you are bearish overall. Now bearish into where? That becomes the question. And you can see this triple bottom right here. And therefore you might say, okay, I am bearish, but it doesn't necessarily mean that I will go all the way down into this liquidity creation point. I can go down into just this area right here, just these bottoms right there. And therefore, as soon as these bottoms are taken, even though you still have a liquidity creation point to the downside and a liquidity grab point to the upside, but you can say, you know what, we just grabbed these bottoms right here, let's say, and therefore maybe I will stop trading right now to verify what will happen next right here. What's the price action that will be delivered next? So you can optimize it, look at the charts, see what's happening as you trade it, journal, and look at your losses and all that. You will start figuring out those scenarios of how the market moves and all that from the perspective of those 2 points right here. I believe that's the easiest way, and you don't need to make it hard. You don't need to complicate your bias. You don't need to do all that. Now, that's how I determine the bias easily, okay? We are going through to the upside after doing this analysis. Now, let's go to the execution. You can apply the same thing that I just showed you all the way up there on this chart right here that we are looking at right now. Now, the price is right here, right? So I'm going to take the price is right here. I took 1 point that is above the price right here and 1 point that is below the price right there. Now, this point right here that initiated this bullish push, what is it? Let's analyze. The market created these bottoms. Look at this. 1, 2, and 3 touches of that line. We have stop losses below these bottoms right here at this low. The market grabbed this low right here, then pushed through to the upside right there. Right? This is an easy way for me to say, you know what? This point, the purpose of the creation of that point was a liquidity grab point in that specific case, right? So that's it. Now, as the market is pushing up right here, first of all, of course, you might look at this double top right here. Where are the stop losses of this double top? Right there. Okay, the high that is right above it. Did this grab this line? No. And therefore, this is not a liquidity grab point. What is it? Let's take this. Boom. Extend it. As you can see, the market is double tapping this high right now. And therefore, this is a liquidity creation point. And therefore, even from an execution on the 30 minutes perspective, as I open the charts, I was in a bullish movement through to the upside, which correlates with whatever I had on the 6 hours. So what I can do right now is I can simply, for example, take this area and choose any area right here in the middle, depending on your execution system, whether you're trading order blocks, whether you're trading whatever is it that you're trading, you can choose a point inside this area right here, from this point all the way up into this point, a good entry point that you believe the market will retrace to, and then take a trade all the way through to the upside. As you can see, this then pushed through to the upside. I took my trade exactly right here. The market, as you can see, it retraced even further than when I took the trade. It retraced almost, let's say, 60% to 50% of that movement back to that area right here, right there. And therefore, that trade, whatever system you're trading, you could have gotten an entry right here and then the market would have pushed through to the upside all the way up into here. Now, this is just a simple way to determine bias, a simple way to think about executions, and a simple start point to start optimizing. Look at the price action, how it moves, what are the scenarios in which this works, what are the scenarios in which this doesn't work, and all that. Great start point for your bias and execution. And therefore, that's it for today's video, and I'll see you guys in the next one. If you liked it, feel free to let me know in the comments below. Goodbye, guys.